This is how the stock market really works. Have you ever looked at the stock market and felt completely lost? Like everyone else seems to know what they're doing except you. Don't worry, you're not alone. At first glance, the stock market looks like some sort of mystical money wizardry where random things happen and the winners get rich while everyone else loses everything. Well, not exactly. Once you break it down, the stock market isn't as complicated as it appears. And that's what we're going to explain right now. Stick around till the end of the video to learn how you can get started investing in the stock market today. Make sure to hit the subscribe button for more videos like this one. First, let's tackle one of the most basic questions. What exactly is a stock? A stock is simply a way for you to own a small piece of a company. Picture this. Apple has 16 billion shares. And let's say you buy one of those shares. Well, now you own a teeny tiny fraction of Apple. Not enough to claim the entire company, but enough to benefit when the company does well. Now that might sound like a small thing, especially if you have bigger dreams of becoming a millionaire. But owning part of a successful company can add up quickly. In fact, if you'd bought 16 shares of Apple back when the company went public in 1980, your original investment of $1,600 would have grown to over $16 million by 2022. That's the kind of life-changing wealth that's possible through investing. But wait, why would a huge company like Apple chop itself up into billions of pieces and sell them to random people? Well, the answer is simple. Money. Selling shares lets Apple raise a ton of cash without having to borrow money or take on any risks themselves. That's the beauty of capitalism. These days, almost every major company is publicly traded, meaning you can own a small piece of them. Amazon, Netflix, Google, you name it. But how can you actually buy these shares? It's surprisingly easy. You just open a brokerage account online, link your bank account, and start shopping for stocks. It's almost like online grocery shopping, but instead of produce and toilet paper, you're buying digital slices of companies. And guess what? You don't even need thousands of dollars to get started. You can buy a fraction of a share. So if a single share costs more than you can afford, you can still invest whatever you have. Plus, thanks to zero-commission apps like Robinhood, all you need is a smartphone and a few minutes of your time. Now let's talk about the ultimate goal of investing: making money. But hold on, doesn't the stock market only invest in long term? Well, yes and no. Short term, the market is basically a guessing game. Who knows what wild events could shake things up tomorrow? But over the long run, history shows that the market tends to go up. So if you have a few $100 and can spare it for a while, investing is worth considering. Just remember, never put in more than you can afford to lose. That way you won't feel too bad if things don't go as planned. Okay, so you've opened an account and bought your first stock. Now what? Well, the next step is learning how stock prices move. Because believe it or not, they don't just stay the same. No, siree. Prices go up and down constantly depending on a bunch of factors. One of the biggest influences is something called supply and demand. Basically, if lots of people want to buy a stock, the price goes up. If more people want to sell, the price goes down. Think of it like a game of musical chairs. If there aren't enough chairs for everyone, the music stops and some people are left out. That's similar to the stock market. If there aren't enough stocks to go around, prices rise since more people want to own a piece of that action. Conversely, if there's a surplus of a stock and not enough buyers, prices drop since sellers have to compete to find someone willing to take the bait. Another factor to consider is the type of stock you buy. Some are considered more stable, like those of large established companies. Others are riskier, such as brand new startups. Generally, the safer the stock, the slower the price might grow. But you also won't experience any sudden crashes. On the other hand, risky stocks could skyrocket in value if the company makes a breakthrough, but they could also plummet if things don't go according to plan. It's like the difference between driving a Toyota Corolla and owning a classic muscle car. The Corolla might not be as exciting, but it's reliable and probably won't lose value. The muscle car could be worth a fortune someday, but it's also just as likely to depreciate quickly. It all depends on your appetite for risk. Are you okay with potentially losing some of your investment for a chance at higher returns, or do you prefer the safety of slower, steadier growth? But wait, there's more to investing than just picking the right stock. You also need to figure out how much to buy. There are a lot of fancy strategies out there, but here's a simple approach. First, decide on your budget. How much can you comfortably spare without hurting your savings or emergency fund? Next, choose a holding period. Are you planning to hold your stocks for a few months, a few years, or even a few decades? Finally, pick a portfolio mix based on your goals and risk tolerance. Remember, investing isn't a get-rich-quick scheme. You won't become a millionaire overnight. Instead, it's a long-term strategy for building wealth steadily over time. So let's say you've researched a company and decided to buy some of their stock. How do you know how much to invest? Well, there's no magic formula, but you can follow a few guidelines. First, never put all your eggs in one basket. Spreading your investments reduces risk. If one company tanks, you won't lose everything since you've got other stocks in your portfolio. Second, consider dollar cost averaging, which means buying a set amount of a stock at regular intervals. This helps you avoid investing all your money at once, which could be risky. For example, you might buy $100 worth of Tesla stock every month. That way you buy more shares when the price is low and fewer shares when it's high, giving you an average price per share somewhere in between. Finally, don't try to time the market. No one can predict short-term stock movements. Trying to buy low and sell high is basically impossible. Instead, focus on the long term. Pick solid companies and hold on to your stocks for years or even decades. Timing the market beats timing the market every time. By the way, if you're enjoying this video so far, please do us a big favor and hit the like button. It really helps our channel and motivates us to keep making awesome videos just like this one. Now let's talk about the elephant in the room. Yes, the stock market can be unpredictable. Prices can go up and down, sideways or in zigzags. Sometimes the market goes down for no apparent reason. Other times it seems to be responding to the most random events. But here's the thing, don't let that unpredictability scare you away from investing. In the long run, the market tends to go up. Yes, there are occasional crashes, but they provide great opportunities to buy in at lower prices. Just think of it like the weather. You can't control sunshine or rain, but you can plan accordingly. Likewise, you can't predict market crashes, but you can prepare for them mentally and financially. Having a long-term perspective and a diversified portfolio will help you ride out any storms that come your way. And finally, let's address one last concern. What if you don't know anything about the stock market? Can you still invest? Absolutely. Thanks to technology, it's easier than ever to get started. There are tons of resources available to help you learn the basics and make informed decisions. Plus, there are even services that can invest your money for you based on your goals and risk tolerance. These robo-advisors use algorithms to manage your portfolio, rebalancing as needed. Sure, you won't get any personalized advice, but they're a great option if you're a hands-off investor. Overall, the stock market isn't as complicated as it may seem. With a little knowledge and preparation, you can start investing today and secure your financial future. So what are you waiting for? Give it a shot and see where your investments take you. Remember, investing is a marathon, not a sprint. Stay focused, stay disciplined, and enjoy the journey towards financial success.